Welcome to RealAg Live, everybody. I'm your host, Sean Haney. That is a nice guitar riff. I like that. I never really paid too close of attention to it. It's a pretty good little tune. Okay, hi, Sean Haney. I'm your host here today on the show. We're going to have a great time today. We're going to talk agricultural markets. We've got John Driedger from Leftfield Commodity Research with us today. If you have a question at all and you want to participate in the program, we highly encourage that. All you have to do is leave your comment question in the comment box, whether you're watching on Facebook, Twitter, or YouTube, or even Twitch if you're there as well. We love participation from the audience, and let's get right to the conversation here. Let's bring in our guest. It is John Driedger of Leftfield Commodity Research. Hey, John, how are you?
I'm doing fine, thanks, Sean. How about yourself?
Hey, man, I'm doing fantastic. I am doing really good. I'm looking forward to this conversation. We were kind of sort of rambling on at the beginning, and boy, man, there are so many uncertainties right now. And when there's uncertainty, it leads to opportunity, and we're seeing a lot of green on the screen here frequently in these futures markets.
Yeah, no, you're very right. I mean, there is a lot of uncertainty, and I guess even coming into the year, we knew there was a lot of uncertainty. Whether it was COVID, it's been geopolitics. There's been a lot of these dynamics that have been in play for, even pre-COVID. Now you start throwing in some weather uncertainty, all these other dynamics, and there's just a lot going on, right? There really is a lot going on. We get adjustments in government reports, USDA stocks reports, StatsCan, all those sorts of things. There's just a lot going on in this market, and certainly from kind of a narrative perspective, the bulls are grabbing a hold of it and running with it, and whether that's fully justified, I guess we'll chat about that and debate about that. But certainly there's a lot of uncertainty, there's a lot of storylines, and it's a lot of fun really from a market observer's perspective.
Yeah, absolutely. Kind of a quick summary: we had December corn up 3 3/4 to 388 3/4. We had November soybeans at 1051. They were up 7. What else we got here? Chicago wheat in December was up 14 3/4 to 607.5. Spring wheat in December was up 11 to 549.25. We had oats up 3 1/4 to 294, and we had November canola was actually unchanged today. January canola was up 60 cents to 532, so essentially flat. So China. Let's not start with China. Let's talk about fund buying. A lot of discussion about fund buying. That really has allowed us to get a little bit lofty here and have some jump in our step as we head higher.
Yeah, well, there's no doubt about that, especially in the soy complex. The funds have kind of been fairly flat recently in canola, but at a pretty good sized position. But the soy complex in particular, they've really been plowing into the long side. They're big time long in the beans. They're long in the oil. Long in the meal. They just built up a big position, and certainly that's your best friend when the funds are buying. From a farmer's perspective, they're maybe your worst enemy when things roll over and they liquidate. But certainly, as long as they're buying, it's that's definitely helped give it a push. It's not as excessive in the corn and in the wheat, certainly, but in the soy complex, boy, they're in big on the long side, and they potentially could stretch it further. But you got to wonder at what point they start bumping up against some limits, because they've been very active.
Does that lead us to this? Because what goes up comes down, and I don't want to be negative here on such an up day, but does that mean when funds create all the momentum higher, is the snapback even just as vicious?
Well, it certainly creates vulnerability. There's no doubt about that, and so that's not to say, the funds are bumping up against limits, so we're on the cusp of a massive collapse. I mean, it could happen, but certainly it creates vulnerability. Now, I mean, we have seen times in the past where funds have had big long positions, and maybe they've actually managed to unwind them in a relatively uneventful way over a period of time, and that can happen as well. They kind of quietly, they've unwound quite a bit of a long position, and it hasn't been super eventful. Of course, we've also seen times when maybe there is a news event or something triggers it. You get a sell-off, that triggers selling. They start running into sell signals, and it kind of feeds on itself, and it can be a violent exit. And that's certainly possible as well. So I certainly would view big fund length, especially again in the soy complex. That's a vulnerability, which it's inevitable that those get unwound. That doesn't mean it's imminent. They might carry this position for a while, but certainly inevitably at some point, there's going to be selling pressure that comes from that.
Now, that fund buying, it is somewhat tied to the optimism around the Phase 1 deal and the fact that China is going to buy, just like it's Black Friday every day of the week.
Yeah. I mean, I think there's a number of things. Certainly the Chinese buying, and whether it's phase one, whether it's reports of their own crop losses due to typhoons and flooding and so forth. Just the fact that they have been actively buying, all those things, have certainly fed a narrative that given a pretty good incentive to be buying soybeans. And then the charts get turned higher. You start throwing in some weather scares. Now you got South American weather and all those things sort of feeding into it. So it's one of those where certainly there's the China aspect. You kind of feed into that narrative. The chart signals turn higher. All those sorts of things contribute. The other thing too, and this is one of the things that I guess I wonder a little bit how it will play out, is you sort of increasingly get these threads, even in the outside investment community, about things like inflation, and then you start seeing ag markets turn higher. You see UN food inflation indexes move higher, and you start getting outside money sort of looking at, okay, we got to start buying commodities, US dollar weakness, grains are cheap, that sort of thing. And that's less of a, sort of a short-term momentum type fund buying, maybe more so of kind of an institutional money placing type thing. And that is a sort of thing that would be maybe a little more patient money, certainly potentially massive volumes. And there's sort of that thread that you sort of pick up a little bit as well in some places. And I'm not sure exactly how it's going to play out. I mean, these institutions are so large relative to, we forget how small the ag markets actually are in the broader financial complex. Yeah. Maybe a little dynamic of that in play as well.
So is this China buying, is it real, or are they, from a demand standpoint, are they just rebuilding stocks? And I guess, how do we know?
Yeah. Well, maybe the most relevant part of that is that last statement you made is how do we know? And I think it's such an incredibly important question. And as you and I were chatting just before the discussion here, Sean, about how, it's so important, and yet it really is hard to know. I mean, if you look at USDA's official numbers for wheat and corn, I mean, China is holding, half the world's stocks or more. No one believes those numbers. I think, anyone would know that those are irrelevant. But the question I think is so critical is how much of this might be potentially kind of defensive stock building, maybe an effort to try and fulfill some phase one, concerns about COVID and logistical disruptions, maybe an element of sort of geopolitical defense, where who knows how things unfold going forward. So let's have stocks and warehouses and that sort of thing. And if that's the motive behind the buying, then ultimately you're just pulling future demand ahead, and it kind of runs its course. The flip side of that is if in fact this is genuine, sustainable demand growth that has some legs to it, that this could carry on a lot longer than maybe the pessimists might think, and that is a very different lens, I guess, through which to view the sustainability of these purchases. No one's disputing what's sort of been happening recently. It's like, how much further can it go? And to be honest, I guess the short answer is I guess I don't know exactly how it's going to play out. I'm a little cautious about it being a bit of a more defensive posture, and yet you got to respect, the potential that they could keep buying, and certainly that's helped. But I think the market would be susceptible and vulnerable to a slowdown in buying, I guess, when you combine with fund length, and that's one thing I'd be a little cautious about. Is that if there's disappointment, it sets itself up with disappointment, I guess, is maybe one way of framing it.
Well, John, here's the difference: is that if it was Australia that was buying all of these ag commodities, we could trust the information. We could trust the intention. Or if it was England that was buying all these products, we know that there's accurate reporting that is coming out of that country as a part of the, something like the G7. That's not the case with China, and so it's whoa. I just about knocked over my keyboard. And that's one of the issues here, is that it creates more questions because we don't even have a good idea around what the actual intentions are, which creates more questions, which creates more speculation, which leads us to where we've been in the markets probably the last 3 weeks with all the fund buying.
Very, very true. And you said those other countries you mentioned, and probably most countries, there's an element of transparency. There's also an element of call it market-driven commercial consideration that's going to be the primary motivation for the purchases or whatever decisions are made. In the case of Chinese buying, A, there isn't transparency, and B, it's not about commercial, or at least maybe not primarily, or there's definitely political aspects of it. and so forth, that really has, very little to do with, there's a margin here, there's a margin there, those sorts of things, right? And so again, that just further muddies the water. And yet, they're just so enormous, they're so massively important to so many of these markets. And yet there's that opaqueness. The intentions aren't the same as they are when trading with Australia or our friends in the U.S. or whatever the case may be, and it just adds this additional cloud of uncertainty. And yet, again, they're so big, they're so important, and that's what makes it so hard to wrap your head around that.
Okay, so if we have inventory, which a lot of the audience does, what do we do here? Because this is the standard thing. Oh, I wish the market was higher. And then as the market goes higher, it gets into tighter and tighter hands, and our mind starts to play tricks on us. So what do we do here?
Yeah, very, very true. Anytime there's a lot of volatility, anytime there's a lot of uncertainty, I've always been a big believer in, making incremental sales. Tend to not, home run swings are great when you get it right. And it's really easy to not get it right. Either you sold way too much and the market rallies, or you haven't sold nearly enough, and then it pulls back and you do the woulda, coulda, shoulda. So I think rewarding the market with incremental sales into these rallies makes a lot of sense. Maybe you overweight those crops that maybe feel a little more vulnerable, that maybe got a little ahead of themselves, maybe hang a little tighter to some that maybe still have a good bullish narrative and have a really tight balance sheet. You can kind of sort of skew your portfolio crops a little bit, if you will. But at the end of the day, there's uncertainty both to the upside and to the downside, both potential, but also uncertainty and negative potential risks that could play out, that I think just prudent risk management, it sounds a bit simple and maybe a little boring, and yet maybe that's just the most prudent way of navigating volatility and uncertainty.
Yeah. Now, I've heard about this strategy, and I'm sure you've had clients ask you too. Is this the kind of the market where you take some risk off the table, you make a sale, and then you maybe buy some paper and let her ride?
Oh, I'm always reluctant to endorse that strategy, and I'm not saying that making a physical sale and then replacing it on paper. I'm not saying that it's never a good idea. I'm not saying that it can't work out. I'm not saying that there's not reasons why that might make a lot of sense, but by and large, I'm always reluctant to kind of I would say endorse that, if you will, I guess. And part of it is it's easy to kind of look at it in hindsight and, I buy it, and maybe you heard of a neighbor that sit there and sold their canola and bought it back on paper and made another $25 a ton or something like that. And no doubt those things have happened, but these markets are hard to navigate. And so let's just take, for example, something like canola. And I think a person could build a case that there could be some upside in the futures. Maybe we're about $15 away from hitting some key resistance. A person could even build a scenario why we might push through 540 if enough things come together. But you also often get situations in a year like this, maybe where the balance sheet is tight, the market spikes early. Like often in years like this, you might actually have where the futures market peaks out fairly early in the crop year. It doesn't mean that the market is necessarily bearish per se, but it doesn't mean that there's necessarily that much more futures gains. In the case of canola, I think there's a pretty good chance that maybe the market is friendly, and yet a lot of that plays itself out in terms of much stronger basis levels going forward rather than the futures going way higher. That you don't benefit from a paper strategy, right? That's the market saying, we'll pay you more for your canola down the road, but we'll pay you if you store it in your bin and you deliver it in March or April, rather than deliver it now at harvest and buy it back on paper. That's a lot harder to try and make money in that strategy. So it's difficult. You think about carry in the market, all those sorts of things. You get buy call options, but then you got premium headwind. All that is to say that that's a strategy that can work out, but it's more fraught with risk than it is sort of let's say a low-hanging fruit because it's so obvious it's bullish. That's obvious in hindsight. In the moment, timing of entry, timing of exit, all that stuff it's tricky. It's tricky, and so I'm always reluctant to wade too deep into that strategy. Again, it's not saying there isn't a time and a place, but it's often easy to just, shoot, I sold too much, let's buy it back on paper and try and capture some gains back.
Yeah,
most of the time you probably get your fingers burned, right?
Yeah, Brian watching on Facebook was going to ask, do you think the short crop long tail principle applies with this big harvest rally? And you kind of just answered that.
Yeah, sorry, could you repeat the question, Sean?
Do you think the short crop long tail principle applies with this big harvest rally?
Yeah, possibly, right? It could be one of those where again, you pop up early in the year, fundamentally tight, and somewhere along the line that story's baked in on the future side early on, and again, there's all these other dynamics sloshing around in this market as well. Big counter seasonal rally, even though supplies aren't actually that tight. Even of course we've got a bit of a surprise last week from USD on the stocks report, but it's not like the corn and soybean balance sheets even prior to that were that tight. And yet the market rallied, kind of went screaming higher, even prior to that. So it's a very unusual environment. There'll be some challenges. It's not going to be easy one to trade paper, that's for sure.
Yeah, okay, and I'll pick on canola for a second. So, like when I look at the breakdown of all the months in canola, we look at like I said, November was unchanged. We got January, March, and May were up at least like slightly, but then the rest of the months from July 21 on are all down $2 to $3 today. Do we take anything when we see that kind of like divergence on a day? Do we take anything from that, what the market's thinking out into the future?
Yeah. Well, I guess there's maybe a few ways to interpret that. I mean, one is we sort of mimic that move a little bit in soybeans as well today, where we're up a bit in the front months, and yet the deferred months were actually red. And there might be an element of say, for example, in soybeans, where we kind of got this window now where the U.S. is going to dominate exports. And then by the time we maybe get into February or whatever it is, they're going to take a backseat to South America. So you get some inverse in the futures market there. But, there's also, an element of canola where it is a bit of a thinner market, so it is one of those where on any given day you might have, let's say, a bit of an anomaly that might cause some spreads to close a little bit out of whack. But certainly it is one of those, again, where probably what I would tend to see, is probably more strength in the front months, maybe some relative weakness in the back months, basically tighter spreads and maybe some inversion in the futures months going forward if this market is as tight as we think it will. On any given day, I guess I don't read too much into that. But, if the pattern continues, and certainly we better pay attention and see what that market is telling us, because it's kind of one of those subtle ways of markets sort of telling us what's going on beneath all the headlines when you look at basis levels and future spreads.
Yeah, like you mentioned, soybeans, we had November beans for 20 up 7, January 21 beans were up 6, and then from then on, March through March, they were all in the negative. So, like you said, exact same trade from that standpoint. John, is there a crop that you think hasn't experienced this fall rally that you think still there's an opportunity to move higher? Is there any sort of a play out there like that, or has this just been general across the board?
Well, it's probably fair to say general across the board. I don't know if there's anything that's been maybe particularly weak where we look and say, oh, geez, there's going to be all this upside building. But there are some crops that we have some optimism for going forward. Like, for example, something like Durham. It's not like Durham has been weak, but it's a market that as we look forward here, we see some tightening and maybe there's some upside going forward. Something like again, we talked about quite a bit about canola, but we're pretty friendly canola basis levels. Basis levels have been pretty weak, and I think just we're going to have tighter supplies year over year. The early part of the demand has been just great for canola. Farmers have been delivering like crazy, but once that stuff has worked its way through the system, we talked about stocks being in tighter hands. I'm pretty bullish canola basis levels when we get into winter and spring. Something like even some of these other crops, something like yellow peas, for example. There's some others. And again, in any given case, is it a big home run? I'm not sure, but I think where there's maybe some upside. Good demand early on. Good buying, good export movement. Stocks maybe sitting in tighter hands as the year goes on. It's going to be maybe a little harder for buyers to try and pry that stuff out. So I think those are a few markets we're watching. One that might be a bit sneaky almost is maybe feed grains a little bit. For example, something like feed barley. And it's, on paper, it's not like, you think, why would feed barley or feed wheat be rallying? That doesn't make sense. And yet, prices are kind of firm, and it feels like a market that's going to end up being tighter and firmer than you would think if you would have just looked at the balance sheet on paper, say, a month ago. And I think it's behaving that way, probably both from some export pull in the case of barley, some firmness from corn, but it just a market that just feels and acts tighter than you think it would be on paper, right? And I think that's maybe tells us something.
Yeah, I'm always, whenever we talk about feed grains, I'm always like, is that a corn fundamental thing? Or is corn pushing the the feed barley higher, or is there actually like a local supply issue on feed barley? Like, did somebody was there more disappointing yields than maybe we first anticipated, stuff like that? But there are, as is going on in the chat here, $5 plus FOB farm right now on feed barley. That's healthy.
Yeah, that's healthy. And and it could be one of those, and I think they say with feed grains, it's always a bit of a tough one because so much of that domestic use, you don't get the statistics the way you do on looking at exports of canola or domestic crush of canola, and you can monitor that pretty well. So it's almost kind of, there's all this stuff going on under the surface. You don't have the statistics to chew into, to kind of sink your teeth into to try and get your head around it. Certainly something like barley, I think, helped with exports. Certainly the corn story helps a little bit too. A better quality harvest. You don't have sort of this feed quality grain per se the same way we did last year. But I think we maybe do have a bit of a tighter market in the prairies. And so even, for example, something like here in Manitoba, so we're going to have a smaller corn crop. North Dakota's got a smaller corn crop. We end up, typically maybe import quite a bit. Well, maybe now we got a little bit of a tighter market on the eastern prairies, for example. Maybe that spills back. I think it's maybe a culmination of a few things that kind of just suddenly, geez, this market is now, say, $5 farm. That's a pretty darn good price for feed barley. No one would have guessed that, a month and a half ago, that's for sure.
You didn't even mention everybody's favorite Cinderella crop, oats.
I have to say, and again, it's one of those crops that's hard to be maybe bullish on oats, but it's certainly, I think first of all, with all the crops, I think in Western Canada, but as you see it with cereals, yield expectations at harvest relative to what they were maybe in late July are two very different stories. And it's not like, it's a wreck, but we hear the word disappointment a lot relative to maybe what expectations were, and maybe oats is one of those a little bit as well, and prices have been creeping up, and it's hard. I don't know if we're going to see the kinds of prices we saw this last year. That's maybe too ambitious, but it kind of has been a little firmer here coming right out of harvest than maybe we would have guessed, based on what earlier expectations were for supplies. So I don't know if it is the same story as some other crops, but it's been better than it might have been, that's for sure.
Well, I think corn is a good example of just how things have been flipped, right? So if you go back to June, let's say June, we had a situation where, corn was bouncing around 310, 320. I had analysts, not you, John, I won't pick on you, but I had analysts talking about, corn being in the like 280 by end of summer range. We're trading Dees corn right now at 388 and 3/4. That's a good dollar above some of the bottom end estimates they were there earlier this summer. What a turnaround!
Oh, yeah, huge turnaround, and not even the fund buy. I mean, funds were heavily short, so I guess they went from short to neutral. Now they're modestly long. So I mean, I guess there's definitely been some fund help in that regard. They haven't even really gotten big on the long side yet. And no, that's so true, and it is one of those. And again, the idea of Chinese buying, and again, is Chinese, does China swing the big hammer in corn the way they do in soybeans? No. Does it help? Sure. Obviously, yield expectations came down. In the U.S., that makes a difference. I think the stocks report, and I think that still is a conundrum, right? They actually bumped the crop up ever so slightly, and yet did they overestimate the crop? Is this big feeding number realistic? Because it's a huge feeding number, But ultimately, I mean, if the stocks number is at all accurate, it's a tighter market than it was. I think it's vulnerable on the ethanol side, but maybe that's slowly getting baked in terms of the lower usage there. But you're right, and again, can you justify it here? Well, I don't know. I'd be reluctant to be a corn bull at current levels, certainly, but we sure are a long way from what people were thinking. And I'll admit, I certainly didn't expect it to be trading anywhere near these levels at this time of year either. And again, so counter seasonal too, which I think is what's really catching some people flat-footed also.
But it gets back to the same thing we've already talked about, which is, do I really want to buy the paper on corn right now at 380? March 21 is at 397 and a quarter. I don't know. It feels a little steamy. I don't know. But yeah. So it's a lot of those questions in many of these commodities. I know we already covered Durham. But Kara is asking, what do you see happening with the Durham markets? It was one of your sleepers, or one that you're feeling good about.
Yeah, you know what? I think we'll see some firmness here going forward in Durham. I think demand is good. It's been the price has been okay, but we think it hasn't really maybe caught some of the upside that we think we should be seeing going forward. I think we'll see some firmness as we get a little bit later on in the year here. And then again, how aggressive. I mean, part of that is going to be a function of how high does wheat trade and corn and some of these other crops. But we feel pretty good about Durham prices here going forward. We think it's maybe got a little more legs to it than what it's shown so far. It's got a pretty tight balance sheet. Demand's good.
Even with the yields that we had in the Durham belt, like across the south, that's where we had the outstanding crops. Like the supply isn't scaring you at all.
No, you know what? I think the demand is going to kind of. We feel pretty good about the demand outlook. I guess it's we like shipments to Europe early on. European imports are big. North Africa. I think demand will really chew through that. We were pretty tight coming in already, so there's some room to have that bigger crop. So is a big home run. Are we going to trade $10 a bushel or some? No, I don't think we're talking silly numbers like that. But I think there's maybe some room for some of this demand story maybe catch up and pull some prices higher here as we look forward.
Okay, let's get back to the Cinderella crop. Brian asks, with the current oat bids in Manitoba, do you think we'll see 4 million acres of oats in 21?
I'm not sure if that's the case. I mean, well, boy, who knows, right? I mean, so much is relative between now and then. But I think actually we are getting in a position here where, so for example, canola looks pretty good. Wheat potentially has some legs to it. Like it was one thing where maybe where if oats looked outstanding, current prices even and everything else looked kind of crappy, then certainly oats is pretty easy to buy in some acres. But there might, I think other crops I think are looking decent enough the way we look at it today that I don't know that we're going to have this massive upswing in oat acres. They're a little smaller than we thought they might be actually coming into the year already. When it was sort of tilted in Oats' favor, I think this past season. So. Again, I guess we'll probably know better as we start talking about January and kind of when some of those last minute decisions get made. But I don't know that we're going to get run over with oat acres next year, or it's maybe less of a risk than we thought it was this last year.
Yeah, there's some competition out there. Like you met even soybeans. We're going to see higher soybeans for sure.
Definitely.
As well in Manitoba.
Yeah, definitely. Yep. Pulse prices are pretty good. Again, who knows what those new crop contracts look like, when you have a year of good Durham prices that, will keep those acres up. Not that maybe Durham and oats are competing for the same ground, but, there's a number of other crops I think look pretty promising the way the setup is today. And that's going to maybe help keep a little bit of a lid on where those oat acres might go, which is good. Then at least the guys want to, plant oats and do well with oats on their farm and it fits and it works. Well, if you aren't getting overrun with acres from everyone else who just sort of jumps in when it looks good, that's a positive thing.
What about pulse crops, John? Anything remarkable there?
No, I just think again it's the outlook I think for lentils is good good movement, good demand. Green lentil prices are starting to get moving. Pretty good outlook for yellow peas, good shipments. Maybe green peas are one where we're maybe not quite as optimistic. I mean that's the one where production was up. Yellow pea production is down a little bit, so. I think the outlook for pulses is pretty good, like a number of these other stories, and I think it's one of the things is, for example, we come back to this China dynamic. The one element of this which certainly is worth giving some pause and thought to is it isn't just fund buying. China phase one, the funds are going to buy soybean futures. They're buying non-futures traded crops. They're buying peas. They're buying sorghum. They're buying other crops. On a cash basis, and so. Those are, of course, tiny markets, relatively speaking, but there's an element of just some genuine, buying that is taking place. And, again, peas is one of those markets that's benefited from that.
I got one more question here I want to make sure I get to is a U.S. election coming up November 3rd. And we're not really sure we're going to know the result right away. It could be days. It could be weeks. It would be terrible if it would be months. There's going to be some court challenges and trying to sort it all out. What does that mean for the U.S. dollar? And obviously I'm interested in the Canadian dollar as it applies to that.
Yeah, you know what? So I guess there's probably a couple things. I mean, one, it's maybe less an element of who wins and more a matter of how close it is. Like honestly, political leanings aside, probably the best thing anyone could hope for is a decisive win. That's probably that probably lends more stability than anything. If it's a close win and there's anything in there that's contestable, I mean, that sets up for a potential train wreck. Hopefully it's a decisive win, and whatever your political leaning, that's probably a better outcome than a narrow win. but within all of that, I have a hard time being positive the Canadian dollar as we look forward. At the end of the day, I mean, it's going to kind of flip somewhat inverse to the way the U.S. dollar is and their sentiment, all these different dynamics around it. I'm generally friendly the U.S. dollar, all else being equal. I mean, it's the world's reserve currency. It is a safe haven, despite them being a bit of a basket case sometimes in terms of what's going on. At this stage of the game, everywhere's a bit of a basket case. It's vulnerable, I guess, in a lot of turmoil, but sometimes you get that counter move where uncertainty actually causes money to flow into the U.S. dollar because it is a bit of a safe haven. But generally speaking, I have a hard time being long-term bullish to the Canadian dollar at this stage of the game. I mean, we got deficits as far as the eye can see, no credible way to rein those in. Haven't exactly been putting ourselves out as a poster child to attract capital globally, not exactly friendly to business and all those sorts of things. And so all of that lends me to think that there's going to be ebb and flow. We're going to rally if commodities pop higher and all those sorts of things. But longer term, it's hard to be bullish the Canadian dollar in my mind based on the fundamentals. It's going to ebb and flow, but I don't think it looks very good.
Could be a short trading trade opportunity there, right?
Maybe.
U.S. dollar drops, gets weak in the short term. Canadian dollar rises, short the Canadian dollar, and as it moves back to normal, you maybe put 3 cents in your pocket.
Yeah, no, that's probably how I would trade the Canadian dollar from the short side, if I was trading it. But again, it's going to ebb and flow and chop around, right? I mean, you're going to have rallies in gold and crude and all that stuff. It's going to pop it up. So, like everything, I think it's going to be noisy, and that's just the environment that we're in.
Hedge funds are going to be just sitting there like,
yeah.
Let's make some
That's
money.
right. Yeah. For every position, kiss it, don't marry it, right? It's going to be that kind of a market, maybe. So.
Absolutely. Hey, John, this has been a lot of fun. I really do appreciate it. If somebody wants more information on Leftfield Commodity Research, where do they go?
Leftfieldcr.com. We got trials to our newsletters, got information about the company, and invite you guys to come check it out.
Please do. The team at Leftfield does a great job, John and Chuck. Always appreciate talking to the both of them. John, thanks a lot, bud. Appreciate it.
That was fun.
Okay, that was a great show. Lots of fun. I appreciate you tuning in. Tomorrow on RealAg Live, we are going to talk to Rob Sharkey of Shark Farmer Podcast, Shark Farmer Radio. Guy's got his own TV show, for goodness sakes. He'll be here tomorrow to talk about what's going on his farm as well as his media business as well. So looking forward to that conversation. I was a recent guest on the Shark Farmer Podcast, and we had a lot of fun. It was a good time, so I encourage you to check that out. Today on Real Ag Radio, we're going to talk to Tyler McCann of CAPI about some ag policy strategic things that he thinks should happen going forward, as well as a conversation with the U.S. Canola Association. There's a potential change to renewable diesel in the U.S. on legislation that really could have a benefit to Canadian canola demands. You're not going to want to miss that on Rural Radio 147 at 4:30 Eastern. Thanks, everybody, for getting real and getting connected with Real Ag Live, and we'll chat again tomorrow. Cheers, everybody.